Welcome back to Morning Trade Live. I'm Renita Young in for Oliver Rennick. And let's focus now on the macro. And to do that, we're going to bring in Jim Bianco, who is president of Bianco Research. Jim, thanks for joining us today.
Thanks for having me.
Absolutely. So last Friday, we saw PCE data. This week, we start a brand new week, a brand new month, a brand new quarter. Let's start there first. What are your thoughts heading into this new trading week first?
Well, let's start with the idea that it's a brand new quarter. And let's back up to 2022. 2022 was one of the worst years on a total return basis. The losses in the bond market were the worst ever, and the stock market had among its worst losses in 80 years. Wall Street has this powerful drug. It's called mean reversion. And so everybody was expecting a rebound this year. Well, we're now at the three-quarter pole for the year, and bonds are again losing money. And stocks, if you take out the Magnificent Seven stocks, they're up less than 2% on the year, underperforming cash. So there hasn't been any rebound. Now, why hasn't there been a rebound? The story I've been pushing all year is that inflation is here. It's sticky. It's not going away. The Fed is going to stay more aggressive than people think. They've already raised rates 5 times this year. At the beginning of the year, we thought they would raise rates once or twice. We're again saying that the Fed is done. We've been saying that for the last 10 rate hikes. Eventually, if we say it long enough, it'll be true. But the problem remains that inflation is still with us, and that's being reflected in higher interest rates as we speak this morning, with the 10-year yield pushing near 4.65 again.
Do you believe that inflation will absolutely continue higher for the rest of this year even? And will the Fed look toward another hike?
I actually believe that we've turned the 40-year cycle in inflation and interest rates, that the bull market in bonds ended in 2020, and that we are now entering a multi-year, maybe multi-decade inflationary cycle. Now that I've said that, that doesn't mean 8-10% or Zimbabwe type inflation, but it does mean that we're stuck with a 3.5-4% inflation world, which means that we should get used to 5-6% interest rates. And when the economy slows, we cut them to 4 or 3. Gone are those days where rates stay at 0 for 7 years, like they did from 2009 to 2015. And I think a lot of people in the bond market and a lot of people in the stock market have had a hard time getting their head around this. There is an alternative to stocks. It is now interest rates. The stock market over long periods of time, according to the University of Chicago, is supposed to return 9%. Well, I could get 5.5% right now in a money market fund. That's almost 2/3 of the gains of the stock market with 0 risk. So there is an alternative, and this is part of the reason why I think everything other than the Magnificent Seven stocks have been struggling so much, because everybody's looking at cash, at money market funds, and going, that's doing better again this year, other than for those 7 stocks. And that's why we see record inflows into money market funds.
That makes so much sense. It seems like people are treating those as havens.
Yeah, they are, and they're also, like I said, viable alternatives. You know, this is not 2019 when, you know, there was no alternative, where it was either you're in the stock market or you get 0 in a money market fund. You now are getting substantial interest rates to differentiate it from real rates at 5.5%, and the bond market at 4.65. If we ever do get some kind of a slowdown or a backing off of inflation, and while I think we're in an inflationary cycle of many years, there will be counter cycles in there. You can get terrific total return gains because you're getting both coupon and price appreciation when yields fall. But I don't think we're ready yet for yields to fall just yet, because way too many people are too bullish on the bond market, and they've been wrong all year. And I think we're in the middle of a capitulation right now, which is why we've seen rates shooting higher so much.
Another part of this conversation, when we talk about how the Fed is going to determine whether or not to raise rates, is it growth that definitely determines it, or is it inflation? You have an opinion on this, though.
Yes. So what determines an interest rate in an economy? Should it be 20%? Should it be 0? Should it be 5? Where should it be? It is the combination of inflation and real growth, otherwise known as nominal growth. That's the two together. Now, for 30 years, we on Wall Street could ignore the inflation component. It was always 2%. You know, you spend 5 seconds, go, that's 2. And we still to this day obsess about real growth components like consumer spending, jobs, industrial production, and the like, and we worry whether or not we're going to go into a recession and rates go down, or we're going to have massive growth and rates go up. I think that's changed now. I think at least as much effort should be applied to the inflation part of the equation. And when you start looking at the inflation part, it being 3 or 4, that means nominal growth is going to stay high. That means interest rates are going to stay high. So, yeah, we might have a recession. And that's why I said earlier, in the recession, the response might be to cut rates to 3, not to cut rates to 0 and start massive money printing like we did prior to 2020, because we are still in a backdrop of higher and stickier inflation. So the falls in interest rates are going to be very limited, I think, as we go forward. Limited in that 3 is probably the floor on the funds rate, not 0.
So since this is a higher for longer environment, by what you're saying, does this take the soft landing off of the table entirely for the next foreseeable, I guess, couple of years or so?
Well, the one thing about a soft landing, and I've been very critical of this, is first of all, it is a word without a definition. No one knows exactly what the difference between a hard landing and a soft landing, and then the other side would be no landing, where the economy just continues to grow. Okay. No one knows what it is. Wall Street loves soft landing because it's in the middle. And I always like to joke, a soft landing is what we call the economy before it either goes into a hard landing or no landing. There's very rarely a soft landing. The last time we saw everybody talking about a soft landing to the extent we're seeing now was 2007, and we went into one of the hardest landings that we've ever seen. I think this time around, all this talk about soft landing is going to be misplaced again, and I think we're going to see no landing because that nominal growth is going to continue with us. If anything, if you believe the soft landing scenario, go back and look at the first and second quarter of last year. GDP was negative for both of those quarters. The stock market fell 20%. That was your soft landing. It was a year and a half ago. Now, that doesn't mean that we're off to the races for the next 15 years because we've already had the soft landing. But I think it does mean that if the soft landing is behind us, that the no landing scenario becomes more likely, and that means inflation stays sticky.
What other kind of indicators are you looking at to watch inflation stay sticky? You're looking at jobs, probably obviously looking at PCE, obviously looking at other very closely related parts of it, but what other type of indicators?
Well, a couple of them. The first big one is going to be energy prices, especially crude oil. Those prices have been moving up. They're up 35% or so in the last 3 months. Now, gasoline prices have been falling for the last few weeks, but I think that's the switch from summer blend to winter blend. And once the refineries are done with that switch, which you usually see in late September, early October, you'll see a rebound in gasoline prices. Now, that'll be dismissed as it's gasoline prices, it's not inflation, but the Fed cannot cut rates. They cannot pivot if we're going to have $4 plus gas. Remember, we're at about $3.80 right now, so $4 is not that far away. The other thing I'm looking at is what's called the base effect. If you look at the inflation numbers from last year, they were very big last year, coming off the summer and into the early fall. So this year, I'm sorry, I said that wrong. They were very small, coming off the peaks in the summer and into the fall. So this year, the monthly inflation numbers will be easier to beat the numbers from last year, which means the year-over-year number on inflation should drift higher. I've been one that's been arguing, while I read on social media and all the economists saying, look at inflation, it's down at 3, it's on its way to 2. I'm like, no, this is the low of the year on inflation. And in CPI, it's definitely sure that the low of the year was June at 3%. We're now back almost to 4%. We should be when we get the September number on a year-over-year basis. And if those inflation numbers are drifting higher with higher energy prices, I think that's going to change the dynamic in the market. Let me bottom line it for you.
Sure.
If the Fed does not continue to raise rates, I think the bond market continues to sell off. The only thing that stops the sell-off now is a Fed that is vigilant about fighting inflation. If they don't want to fight inflation and they want to say they've done enough, and let's wait and see what the long and variable lags are, then I think that the 10-year continues to sell off at this point. It was only when the Fed started hiking 75 and 75 and 75 last October, and they meant it, that the rate hike or the rate rise in the 10-year stopped. So if we all say the Fed's done and the Fed's not going to raise rates, then get ready for 5% 10-year notes, if not higher, and probably in short order as we move forward from here, because the inflation story is not going to get any better in the next few months.
And as we look to how investors are positioning their portfolios for this, getting into money market accounts is one way. But what's another way that you see investors positioning their portfolios for this possibility?
Well, I think as far as the positioning goes, remember the biggest drug on Wall Street is mean reversion. And what that means is, the stock market had one of its worst years ever. The bond market had one of its worst years ever in 22. Everybody pile into stocks, long-term bonds and stocks for 23. There has to be a rebound. And like I said, other than 7 stocks, there hasn't been a rebound. So most of the positioning this year has been wrong, and it's been painful for a lot of people. Now, where has the positioning been working? You're right. Short-term interest rates, because the yield curve is inverted. Money market funds at the highest point in the yield curve get 5.5% return with very little risk. Like I said, there's 8,000 stocks, and only 7 stocks have beaten money market funds out of those 8,000 stocks right now. Money market funds have beaten everything from the 5-year to the 30-year bond. So they're among the single best investment options that you could have had this year. Oh yeah, you might have bought maybe SPYs or some kind of other index fund and you're up 9%, but that's all 7 stocks. And you're up and you're making a bet that Nvidia is not going to sell off hard, or Tesla is not going to sell off hard, because the indexes are so tied to those stocks right now. It's no longer a broad-based bet on the market. So for positioning, I would say most people have been wrong and it's been hurtful for them, but the place to be is the highest point in the yield curve. That has been what's been working this year, and I think it will continue to work.
All right, lastly, you see more people, am I correct at thinking this, that they're more active managers with their portfolio because of all this happening, because of the more short-term rates that they're coming upon?
Yeah, there is people that are trying to be more active because of the volatility in the market and the uncertainty in the market as well. But again, the reason that they're active, and you see it with 0 DTE options now being over half the options that trade every day, but the reason that they're so active is because they perceive a big oversold and they perceive a big opportunity to make money quickly, and it hasn't been working out for them just yet.
All right, Jim Bianco, president of Bianco Research. Thank you so much for your insights. Now, coming up next, we'll begin the